It's time now for your bond update, and there were some big outflows from riskier credit funds this week as investors grew ever more concerned about global trade tensions. Let's go now to Lisa Abramowicz. Lisa.
Yeah, Scarlett, you saw high-yield bond funds getting their biggest outflows of the year. Take a look at some of the ETF flows, which kind of can be representative of broader market activity, and certainly were this week. HYG, which is the largest U.S. high-yield bond fund, saw its biggest one-week withdrawal of $1.6 billion since 2016. JNK is also a high-yield fund. LQD is an investment-grade fund with nearly $1 billion of outflows, too. So a little bit of risk aversion at a time when there is an escalating trade war between the U.S. and China. That said, let's put this into perspective. Take a look at the returns so far this year. You can see that high-yield bonds have returned nearly 10%, 9.9%. Investment-grade bonds have returned 12.1%. So it's been a very good year, albeit one that has been marked by a bit of caution based on the fact that you do see a better return on investment-grade bonds than high-yield bonds, which is unusual at a time when both are up. In the meantime, if you take a look at what this means for borrowing costs, they remain very low, despite the fact that you are getting outflows and some investor caution. They're still substantially below where they were back in October and November, where they were almost 2 percentage points more, at least when it comes to high-yield bonds. So even though there does seem to be some risk aversion, still not a bad time to borrow, and it's coming after a really good time for credit.